The financial system is looking highly dangerous at this point, with constant and never-ending risk being added. As stock prices fall, companies may begin to see the possibility of increasing productivity by decreasing their workforce. Simply laying off a percentage of their employees is the fastest way for companies to give their stock investors confidence. Today, the lack of a sound foundation has slowly started to make investors worry, only exacerbating the underlying issues. You came here for the truth, so let me unveil that for you. Today we're going to look at what could be the next Lehman moment. People are waiting for it, they're anticipating it, not sure where it's going to come from. So we're going to look at various economic indicators today. So let's begin by taking a look at this. You are seeing the global yield curve and its inversion. People have been waiting for the inversion to occur, whether it's on the 2 and 10 year, the 3 and the 5 year, and in this case, the global yield curve being so important. When we look at interest rates rising, whether it's the Fed funds rate, perhaps it's the LIBOR rate, we always have to pay attention to the technical indicators, not because you and I see them as important, but because of what's happening with computer algorithms. It was Druckenmiller who said that they can't even figure out the market today because of computer algorithms, and he has been one of the most successful investors ever in history. This has been a mess today, and we could see anything occur. It's simply a matter of time. Where it's coming from, that's the difficulty. But if you keep your eyes peeled, you're going to start to see all of these cracks appear. And the closer you look, the more you realize how big that crack really is. Flatter than a pancake, the flattening trend is spreading further out along the curve. On the left-hand side, the 2-year to 5-year spread. On the right-hand side, the 2-year to the 10-year spread. And we're basically at 0 or below for most of these different indicators. It had looked like it was moving in that direction, and eventually it did happen. We'll see all of them invert. The question is, how long from the time of inversion to the time that we officially get a recession? Well, it's anybody's guess. Performance of major asset classes. And this is the importance of diversification, though I don't see all paper assets as diversified. But looking at this, you could see at least more diversification within this whole paper environment. Whether we're looking at the S&P, the Russell, the MSCI, all country world index, excluding the US. And then, of course, we have the treasuries as well as gold is in here. Now, we're looking indexed at 100 at the beginning of November up until present day, and it shows us the diversion that occurred at the beginning of December, where we saw things like the treasuries, like gold, outperforming the S&P 500, for instance. And this happens to be a problem for many because they don't diversify. They have invested in, for example, an S&P 500 ETF, believing that they're diversified because that's many stocks within a basket. However, that isn't the way it works, see, because they're all connected together. Some do better than others, there's no doubt about that. And while it is more diversified than buying one individual stock, it's very difficult to do so and really have the ability to weather the storm. That's not the way it works in reality when things are looking very bearish. That's what's happening today. Certainly things could turn around, but at this time it really makes sense to be truly diversified. The more diversified, the better. Taking away the punch bowl. The Fed's quantitative tightening program is reducing its QE holdings by $50 billion per month. Actually, it's much less than that, but at least that's their goal of $50 billion per month. I believe the last time I saw it was something like 36 billion, but regardless, they are reducing their balance sheet, and this is going to be the most important factor for what we see into the future. The stock market is completely relying on central banks and their quantitative easing policies. If they are to pull back on that, obviously that's going to impact the markets negatively. There's no other way to think about it. That's just the way it goes. So you're seeing the blue line, which is basically their actual holdings, and then the black line is their projected holdings. And you could see that over time, they're still going to be holding on to a lot on their books. And that assumes that nothing happens in between now and then. And of course, that's just not realistic. If you're thinking that the Federal Reserve is going to be reducing their balance sheet down to zero, you've got something else coming. This is not the way it works. They're doing so to reduce the balance sheet. They're going to be getting down to a level of, if you want to be fair, and this is going to last until 2020, then they're still holding approximately $3 trillion on their balance sheet. How in the world is that normalized? It's not. Okay, if it goes to 2021, maybe they can get rid of another trillion. They're still holding $2 trillion worth. This isn't realistic. So when you have a crutch holding up the system and you're pulling it away slowly but surely, you're going to see equities and other asset prices being reduced in conjunction with their balance sheet reductions. It's the way it is. That's the way it has been since 2009. They messed up all of the systems that are currently in place, and a lot of the technical indicators don't make sense anymore. But this is the reason why. Central banks are supporting a market that should be falling. This is an article out of Bloomberg. It's talking about Ned Davis research, but I just wanted to be specific about why I'm showing you this. And it's that whenever we have a change in the markets, you tend to see all of these different analysts come out and change their predictions. It's as if their predictions mean absolutely nothing. So they say the Dow Jones is going to be at 30,000. And of course, it sounds very good. People become bullish, and then something happens, something changes. Whether it's the VIX issue from earlier in 2018, whether we have the problems that occurred from October up until present day in December 2018, there's something that occurs, and that affects the equity prices. That starts to create some tensions back and forth. Businesses start to close their doors and so on. Then you have that same exact analyst come out and say, okay, we're going to have some troubles. It's going to look very weak, so we'll see how it goes. I'd say new prediction, Dow Jones 25,000. So what happened to that 30,000? All of a sudden they just changed their predictions, and it's based on new information that comes up. But what exactly caused that to happen? This isn't helping people. By telling them it's going to be at 30,000, suddenly it's at 25,000, and you start to spook people. You start to worry them because you're changing the prediction. Don't have a prediction based on a certain number, but of course that's what everyone's looking for because they want to know where they think it's going to go. They want to be able to determine the future, and that's a mistake, very big mistake. So they get into the details of this, and I'm just using it as a placeholder for the most part. I wanted to show you this as well. Banks say that they aren't cashing in on this market turmoil. Financial market turbulence is supposed to be a good thing for Wall Street trading desks. Not so this quarter. This is out of Bloomberg and basically just trying to tell us what happens with the financial industry. The more volatility there is, usually they're able to capitalize on it, but that's not the case right now. Banks are struggling to capitalize on tumult across stock, bond, and currency markets, in part because many investors are staying on the sidelines as the year end approaches. Another culprit, dramatic but short-lived swings in asset prices that are striking some of their clients hard, while also making riskier bets even more treacherous. There's a very, very uncertain sentiment in these markets today, and you're seeing that being quite apparent in a lot of these individuals, in a lot of these businesses that are talking about worrisome 2019 issues arising. And that's not good because at this time, we are always concerned about what could happen. And of course, here we are from October to December. It's looking terrible so far. That's the trade issues. That has been the VIX issue back in early 2018. That has been the stocks declining. We have seen the FANG stocks. We've seen scandal after scandal in so many different major institutions and so many other things that have occurred. Where the linchpin is, we'll only find out in time. What began guardedly as traditional lenders retreated post-Lehman has exploded into a financial industrial complex rapidly approaching $1 trillion, with money streaming in from pension funds, insurers, and hedge funds. Remember how we were told that everything is much better these days, that there isn't that risk-taking, that we're not going to have to worry about all of the issues from 2008 up until present day because everything was resolved and they put increased regulations and they made things more sound and safe and secure. But unfortunately, that isn't true. It's part of a decade-long borrowing spree that has swelled the world's supply of credit to private businesses to 98% of gross domestic product, of their GDP, 98%. But instead of big corporations, this lending boom is filtered down to small small town or regional businesses looking to cash in as money managers and private equity firms fan out across the country. So this article gets into this particular company, talks about it, but I just wanted to cover the fact that what we are seeing today is not just the case of big banks and what they do on a daily basis and the fractional reserve banking and derivative products that we saw in the previous crisis. We are seeing new things appearing today. We are seeing the entirely new way of doing business here, new sorts of ideas and creations that are being conjured up by the mad scientists of the financial world. The rise of the shadow banks. Non-bank intermediaries such as private equity firms and hedge funds have been making up a greater share of the global financial assets since the financial crisis. And you're seeing that right here. 40% banks, 30% non-bank intermediaries. It has been escalating over the years. Absolutely, there's no doubt about that, because they're looking for higher returns. They're looking for new ways to make money in this zero interest rate world that we were living in for so long. And even today, it's still very, very low. So they're looking for alternatives, and that's when the businesses come up and try to offer solutions to that. And in fact, of course, it makes it even more dangerous. So it might be less total volume, but the danger, I believe, could be considered to be much higher. Whom to call when the bank says no. Since the crisis, private funds have raised hundreds of billions of dollars to make loans to small and mid-sized companies. This is from 2009 up until 2017 numbers, and you're seeing what has happened. Clearly a dramatic escalation nearing here $100 billion, and that tells us that there's always a new way to make money, to get money, to be able to do business in some sort of no underlying asset, I guess, if you want to call it that. So this is what they do in all of these different firms. They are making money off of nonsense, and then eventually it blows up. So who knows where it's going to be, but it's certainly not looking good. BBB, my baby. The explosion of corporate bonds since the last recession has been led by the lowest investment grade rating, BBB. Value of the US corporate bonds by rating, and you can see the BBB right here. If I highlight it for you, it is one step above junk, and that has really been escalating quite a bit since the financial crisis. This is 2009 if you can't see that, but essentially it has expanded so rapidly throughout these years. Trillions of dollars have been added here, and it's not the high quality stuff. Of course, we can't trust the rating agencies anyway, but at least it's probably less likely to have an issue with it. But this is what happens, and what this means, you have one step above junk, is that when you encounter a recession, things start to get downgraded very fast. And this is going to happen again. We know that. This article is talking about student loans, and basically what you need to know is that when you're taking out a student loan, or any other loan for that matter, let's say it's $50,000, you're not going to be paying back $50,000. You're going to be paying back a lot more than that, and the longer it takes you to pay it off, the more you eventually have to give up. That's what people aren't understanding. They take on debt as if they're winning, but I assure you, whoever's giving the money out is the real winner. See, when you take out a student loan, let's say $50,000, by the time you start paying it, this article describes, it's probably something like $56,000. And that's just in that period of time. You haven't even started paying down the loans yet. Then it comes to 1 year, 2 years, 5 years, 10 years, and that money is compounding. And you can pay off, what they suggest is to pay off small amounts to ensure that you're not accumulating at least the interest on that, so it remains at that level. So they try to get you to keep it down so at least it doesn't go beyond that, but that doesn't solve the problem. And I just want to let people know what is occurring today with student loans. All of that money that's in there is actually being securitized, collateralized, and shipped off to different institutions where they have this crazy idea to make money off of other people's debt. I think it's insane. I think it's crazy the way it works, but they are taking your credit card debt, your student loan debt, and everything else, packaging it up and selling it as a collateralized debt obligation instrument or one of these other derivative products, and there's no possible way that's ever going to end well. So this is what I'm talking about, and unfortunately for many people, it isn't looking good because they are going to be too far into debt, and it's going to burden them severely as this deflation in assets continues. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these 2 books have it all. You can get everything you need from A to Z, from the foundation to the history to the asset classes, making money. There's a lot in here that you need to know about, so check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com.